You are probably a terrible investor. Don't take it personally, almost everyone is. This is because you are human and are prone to making investment decisions based on emotion, which regularly leads to bad decision making and underperformance.
The study of psychology and how it affects investor decisions is known as behavioural finance. You won't need to be an expert in this field, but it's important to understand how emotions lead to terrible investing. There are numerous biases or theories that negatively affect our ability to make sound investment decisions.
In fact, we regularly see beginners demonstrate these behaviours, which is why they lose so much money. By the end of this video, if you don't know or understand what we've discussed, then you should think twice before investing your money. In this video, we're going to discuss 5 of the key biases. And if you watch this video to the end, we assure you that you will become a better investor. Let's check it out.
Welcome to MoneyUnshackled.com, the investment channel and website that sets you and your finances free. This is Andy, I'm Ben, and if you like what we say, hit the like button, click subscribe.
Also, check out the MoneyUnshackled.com website where we've added a 4-step guide to stock market investing that you can download for free and hundreds of pounds of welcome bonuses that you can snap up if you sign up to one of the investment platforms listed on the offers page. The link is in the description below. Let's get into the video.
Number 1. Overconfidence. Psychology has found that people tend to have unfounded confidence in their own decision making. Essentially, people are overconfident in their abilities. 80% of drivers believe themselves to be better than the average driver. Of course, this is impossible as only 50% can actually be better than average. The other half must be below average.
Generally in life, this is a valuable behaviour and positivity is a very attractive trait. However, when it comes to money-related decisions, overconfidence can be your downfall. An example of this is when an investor does not diversify enough because they believe in the stocks they've picked. Surely they can't be wrong, can they? We've seen some people, even some other investor YouTubers, believe it or not, hold 40% of their wealth in one stock. Pure madness.
As Warren Buffett says, it's only when the tide goes out that you can see who's been swimming naked. Overconfidence also leads to
Number 2, self-attribution bias. This is a tendency to attribute good outcomes to your skill, but bad outcomes to luck or misfortune. We think we can all be guilty of this at times. When things are going according to plan, it's common to believe this is because of our skill. But when things go badly, then clearly we've been unlucky. But why is this a problem?
This bias gets in the way of the feedback process. By blocking out the negative feedback, you miss out on opportunities to improve your future decisions.
Number 3, money illusion. This is the one that we find most fascinating. It refers to our tendency to ignore inflation when assessing the value of something. It's even worse if we accept that inflation is far higher than reported in national statistics.
Almost everyone outside of the world of finance has no real understanding at all about the time value of money. Yes, they've heard of inflation, but they don't apply it. For example, imagine the FTSE 100 reached new highs of 8,000. Is this a good thing? Sure sounds good, we would have made a lot of money.
But in 1999, the FTSE 100 hit a high of almost 7,000. So okay, 8,000 does seem better as it's a far bigger number, but it was 20 years ago. And if it was reaching inflation adjusted new highs, it would need to be hitting a valuation of around 12,000.
Obviously this is not great, but don't fret too much. The period includes an historic bubble known as the dot-com bubble. This is not normal behaviour. Also, the FTSE index price does not include the dividends that are being paid out to investors over that period, which would have been a tidy sum on top.
Back to the problem of money illusion. People are the same when they save money. They may see the nominal amount increase by 1%, but in reality, its buying power has tumbled.
We see parents dutifully saving for their children over 18 years in a cash junior ISA without realising that the real value of the money that they are saving is being eroded year by year. The nominal return looks rosy. The real return is very different.
Number 4, anchoring. This is when people are inclined to give too much weight to their recent experiences and ignore the long-term trends.
For example, property only ever increases in value, doesn't it? In our lives, yes, it pretty much has. In fact, for the past 50 years or so, property has just gone up and up, so it's natural to assume that this is how it has always been and will continue to be.
But only over the long term do we realise that this isn't really the case, Apparently, for the first 60 years or so, property was flat in the 20th century. Despite this and what seems to be overvalued property, we still think it will increase. Maybe we are making the mistake of anchoring, only time will tell.
Number 5, confirmation bias. One thing that we are very familiar with having worked in financial analysis. Confirmation bias is when investors have a bias towards accepting information that supports their already held beliefs.
People have a tendency to pay close attention to information that confirms their belief and even ignore information that contradicts it. Having worked in financial analysis, we know that it is possible to find data that supports any argument. You may have seen different media outlets report on a story with completely opposing conclusions, even though they both had the same source data.
For example, if you were to analyse a stock, you would be able to find both positives and negatives. If you were suffering from confirmation bias, you would pick out the data that supports your viewpoint and probably lead you to a wrong decision.
Important takeaway. What is important is that psychology has an impact on your ability to invest successfully. It is this reason why many investors choose to remove themselves from the equation and automate processes. These investors know that their innate emotional flaws ruin their investment returns, and automation is one basic remedy to this.
For example, many investors will choose to invest regularly via a direct debit. This removes the worry over whether or not you're getting the best price. Another tactic is to set up stop losses, so that it minimises losses and prevents you having to make a difficult decision yourself.
Question of the day: what behaviours or biases have you demonstrated? And most importantly, what have you learned from them? Let us know in the comments section. Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money. If you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.